All right, everybody, welcome. Doug McKay, anti-wallstreetguy.com on the 24th of June, 2011. Let's start off with a chart of the SPY. This is a daily chart of the SPY. Closed down 1.16% today. The overall trend now for the 8th week in a row in equities is still down. 8th week in a row. Whether or not there's a bounce to be played here, the overall trend for the past 8 weeks is down. So let's take a look at this chart. Yesterday, the SPY, S&P, Dow was down very big. And when we look at this kind of under a microscope technically, you can see that intraday, that maybe the purpose of these lows were to take out the stops that were parked under this low, which was on 616, and then also this low, which was on this past Monday, 620. So that certainly happened. This higher finish yesterday in this candle, when the market rebounded for whatever reason, Greece or whatever, looked like it was purposely taking out these stops that were parked here, and then also to fill this gap. So it looked like there was a possibility today that this could rally this morning. Obviously, that was not the case. We know, regardless of where this goes, bounce or no bounce, the trend is down, and we believe that the bounce would take us maybe to 132, 134, 1320, 1340 on the S&P, only to go lower. In other words, the same old lower highs, lower lows. Is the market oversold? Yes. Could it continue to be oversold? Absolutely. Regardless of whether we go straight to this target here, the Japan lows here back in March, or we bounce a little bit, the odds are that this is going to be taken out. Now the next thing is it going to be taken out intraday and then rally at the end of the day, and then that's it for a while? We go higher, and who knows, maybe we go through 135 at some point and we're off to the races again. It would be time to put the foot down and get very, very long. I don't think that's going to happen. I'll tell you why. Let's take a look, and certainly if it does happen, we'll participate in that. But let's take a look at a weekly chart now. And if we remove this line here, and we remove the eventual target, which is the March Japan lows, and we'll take out support here. So when we look at this on a weekly basis, it certainly looks like, regardless of whether we bump up here to 132, provided we stay under this area of basically 135, the mid 134s, it certainly looks like, until we get above this left shoulder, and certainly this head fake here, it looks like we want to go to 120, which is 1200 on the S&P. Now, give or take a little bit. Maybe that's 1228. Maybe it's 1170. But I still believe, like I've been saying for several weeks, that some point in 2011, at a minimum, we're going to see 1200 on the S&P. And obviously, we're not that far off. We're 60, 70 points off right now. So that's it. Let's take a look now at. Let's go back and take a look at this on a daily chart. And again, let's transfer this to just straight S&P cash. Obviously, the chart's going to look very similar. This is a post that we put out earlier in the week that maybe we'll see a little back and fill. Let's see, we put this out on the 21st. So that would be Tuesday. We said we'd see maybe a little back and fill around 1300. Then we think 1320, 1340. That has not happened. As you guys know, if you follow the blog, in some of the managed accounts, we put a position on right here. We jumped in with 10% towards the close on Monday. Looked like a pretty decent move because here's where we finished, obviously, on Tuesday. When the Fed came out, I added another 10% here in some of the managed accounts, and then it all blew apart yesterday. And I thought, you know what? I just as soon sit on the sidelines. We went to cash for those that were 20% invested, and we'll just see. Even if we have to buy it back up in here, that's fine. We just want to see it stop falling. If we want to play it long, we'll wait for the trend to resume in high probability in terms of looking at a chart. Now, I also believe that it would be dangerous here, or or less probable. I think you'll be able to get a better entry point to just simply go short, unless you're day trading this. So we would rather see the ideal short is if we come up in this area and then it starts to roll over again, then we would get short. All right. So right now, again, I believe the best place to be in terms of equities at this point is in cash. Are we going to take out this Japan low next week? I don't know. But obviously, we do believe that that's a target. It's just a matter of whether we go north first and then down, or we take it out. And then what we have to decide, obviously we'll be sitting out at that time, but what will be interesting is, will this be a buying opportunity because, again, it trades through the Japan low and through the 200-day moving average, and then we take off again to shake everybody out? Or is it just the opposite, where we're taking out the 200-day moving average and then the institutions start to lighten up and there's more selling? So we'll see. Next week should be an interesting week. Let's take a look at the buck. This is the ETF. Let's take a look at this on a weekly basis. And these are just various posts we put out. You probably can't see them on this video, but if you go back to 6:15, you can see them. This would be a counter trend trade here in the dollar. I said that it looks even better above 22.50, which would be in this area up in here. But I like the idea of this. If it closes above the high that was put in last week of 21.67. If it gets above this candle, last week's high, 21.67. That's a nice looking chart. I would definitely take that trade, and here's why. Most importantly, because of the counter trend trade, but this is kind of a low risk percentage wise. I would have my stop just under 21 or right around the 21 range. So the risk there, if you picked it up at, let's say, 21.65, 21.69, 21.70 is doable. Okay, let's take a look at gold. Now, we have a very, very, very limited number of clients in GLD, and this is more their preference. The bulk of our managed accounts have not been in GLD for at least a month or two. This was a highly probable trade early in the week. Once we got above this, basically pennant or symmetrical triangle. So that looked very good. But it started to blow apart yesterday. Again, everything doesn't always work, obviously. Again, it's a game of probabilities. So we took half off yesterday. I'm looking at the futures for the few individuals that still have this via their choice, and me managing the gold is I want to see the futures hold 1,500. And today I believe we touched 1,500 on the futures and bounced off that. I think we closed around 1,502. So again, I like gold for everybody, all accounts, if we get back above this high. In the meantime, it could go back down here to support. You can see that we put a stop on the blog there. But I would have to see it get back above here to get long, unless you're playing some type of bounce off of good support at around 140. Do I think we're going to come back and fill this gap? Sure. But it could be just a gap fill and heading down again. So we get above these highs in here, then it's good to go in terms of testing this area again. And obviously if it gets through here, we're going higher. That's a breakout where it will be self-fulfilling technically. But in the meantime, this can happen. It happened in the S&P about 3-4 weeks ago. This was a false breakout. So you have to adjust, and you always have to ask yourself about the what if. All right, you guys, that's it. Doug McKay, antiwallstreetguy.com on the 24th of June, 2011. The overall trend in equities for many weeks in a row now is still down. A lot of overhead supply, so be careful. Look at your individual stocks. Use stops. You can always get back in. We'll see you next week. Thanks.